Welcome to another video by TM Tax Consultants. This video provides an overview of fair market value versus declared value, focusing on Section 68 valuation and how declared consideration is tested under Pakistani income tax law. Every asset transfer involves two values: the declared value, which is the price recorded by parties, and the fair market value, the benchmark used by tax authorities. Why this matters is that the FBR uses the higher of these values to compute taxes like capital gains and withholding tax. Under Section 68, the fair market value is defined as the price an asset would fetch on an open market. For immovable property, FBR-notified valuation tables are binding, and taxpayers cannot override these figures for tax computation purposes. Declared value refers to the consideration recorded in deeds, wealth statements, or tax returns. Be aware that declaring a value below the fair market value does not reduce your tax liability and may trigger FBR queries or Section 111 additions. This comparison highlights the key differences. While declared value comes from the parties involved, the fair market value is determined by regulatory authorities. Using a value below the benchmark can lead to significant tax consequences and reassessments. The Section 68 valuation hierarchy starts with FBR notified values, followed by provincial DC rates. If these do not apply, the open market price is used, and failing that, the Commissioner will make a determination based on a reasonable assessment. Recent changes in the Finance Act of 2026 clarify that for inherited property or family settlements, the cost is now anchored to the fair market value as of the date of transfer to the beneficiary. A gap between these two values has practical impacts. It affects your advance tax at transfer, can create exposure to Section 111 investigations, impacts capital gains computations, and requires careful reconciliation in your annual wealth statement. Consider this example: a property sold for 12 million PKR, but with an FBR value of 18.5 million PKR. Taxes are computed on the higher 18.5 million, and the 6.5 million shortfall becomes a candidate for tax scrutiny. In summary, always declare your transactions accurately and benchmark them against the official fair market value to avoid unnecessary tax risks and compliance issues. Thank you for watching this video. Please don't forget to like and subscribe our channel.